Hello, everybody. Good morning. Welcome to yet another session of Beyond Bulls and Bears. We'll wait for just 30 seconds more so that more people join and then we'll start our regular session. Yes, friends, good morning. What a week it was. Finally, market showing the strength which it is known for. Finally, there's something to cheers for the Bulls, and the market was up handsomely this week, following up to the strength which we showed earlier in the March before the tariff related uh, news flow made the market correct. Incidentally, the market has closed at a very, very crucial level. We are nearly, we have recovered back from the lows, we from the lows before the tariff war started, and this is incidentally technically we call it the double top, where we are touching the highs against which we made in March. And this is also the 50% retracement to the whole correction right from all-time high to the recent low of 21,800 odd. What is also important to note here is that 21,800 has now become a double bottom also. These are very important parameters from a technical perspective, which all of you may not be aware. What it means is that technically, if we close uh, next week and we trade above the double top level, the technical traders will take it as a sign of sustenance and will look to become more of buyers rather than sellers on the rise. Incidentally, while Nifty is still 10% below the all-time high, Bank Nifty is very close to all-time high. And if market goes up, Bank Nifty should continue to do well, and which means Bank Nifty will see a breakout of all-time high. I'm fairly confident of that because of the results which we saw last week. Sorry, to yesterday in terms of two of the largest banks, which I'll cover later in the presentation. So let's discuss the market first. The markets this week rallied purely based on large cap, something which we have been talking about for repeatedly the last 3 months. That whenever the correction is over, the market will see upside more in large caps and sustain buying in large cap because mid and small caps are not only expensive, they do not have the same earning tailwinds as a large cap, and because people are randomly stuck at various levels, they will look to sell on every rise, which is why neither the mid cap index nor the broader market is seeing the same rally as we are seeing in the large caps. Now, within the large caps, also, what is equally important to understand is the rise is coming in only those stocks where there is little earning uncertainty. IT and pharma are continuing to struggle because of whatever is happening related to US tariff and the fact that the earnings are not there. Again, quite clear from the results which came out uh, in IT so far, which again we will discuss later in the talk. So, where the rally is coming from? The rally is coming from banking, the rally is coming from cement, the rally is coming from consumers, the rally is coming from individual stock and sectors where you are seeing enough traction of earnings and business visibility. Broadly, what we are seeing is the sectors and the companies which are more focused on India consumption, more not related to US economy, are continuing to do well. And that is what we believe will continue to happen as we move forward. Without getting into stock specific, I can very clearly say that the earnings in this quarter will be better than the last quarter wherever there is link to the Indian economy and the broader economy. Those struggling with US and exports will not see the same traction. We will now come to quickly we'll touch upon the earnings which have come so far. Just a quick start, not much have come, but few important have come. Let's just start with IT. TCS, Wipro, and Infi, broadly the top three IT companies listed on the exchange, reported the numbers, and directionally, all of them have shown the same thing as a process. Just give me 1 second, please. Sorry about that, guys. Yeah. So, broadly, what we are seeing is not only a lack of earnings reporting, lack of confidence for the earnings going forward. I have not, I don't remember when was the last time I saw these companies talking about less than 5% growth in revenue for the whole year, negative growth in Q1, a clear visibility that the discretionary spend and the spend related to IT, driven by the US economy, is struggling. And that's something which we have been talking about for some time. That's what we have maintained as a stance in our portfolio. And that's paying off now. I will say that yes, IT has corrected fairly from the top, but they are not cheap anymore. I think they are more back to the mean valuation. And if next 1 year there is no earning growth, rather a degrowth, even if they give a 0% return, they will remain at the mean valuation. So there is no reason for upside in IT even from these levels. And as a result, what is happening is the money from IT, which is the defensive and pharma, is moving to defensive names and sectors, which is why Bharti is up handsomely, which is why the consumers are moving up. But will it sustain? The answer is it will only sustain in those names where the earnings will come. And this is where we believe that banking is ahead of the peers. I clearly remember 6 months back. Yeah, 6 months back, there was a lot of talk about CASA not there, asset quality issue in retail, and people were, and banking was underperforming because of that. And there was a lot of apprehension of having banking in the portfolio. We maintained our stance, we reiterated our stance that banking cannot be looked at from a couple of quarters perspective. And in 6 months, both ICICI and HDFC Bank reported handsome numbers, while ICICI reported much better than HDFC Bank. But HDFC Bank, for whatever challenges it was, reported a handsome number. Look at the tone of the management of HDFC Bank on the call yesterday compared to what it was 6 months back, and you will realize how the things have changed. They look a lot more confident, they look a lot more business focused, while for ICICI Bank, it's a different level altogether. Both the CMDs said that probably the worst of the challenges are done with, which will give the confidence to the market. Now, I I send out a note to my clients and key people. Some of you would have got it, some of you may not have got it. That if we compare the numbers of HDFC Bank and ICICI Bank, there's a huge difference. ICICI is on a different planet altogether. And yet, ICICI trades at the same earnings multiple to HDFC Bank, which for me is not sustainable. Will the market correct it immediately or will it take 3 to 6 months? I leave that to the market. But I believe that ICICI has 15 to 40% upside over the next 6 months to 1 year, while for HDFC Bank it will it may not fall if the earnings come, but the upsides are limited because the growth is much lower compared to ICICI. We will look for SBI and Axis to report the numbers, and if they use the same confidence, then definitely it augurs well for the banking sector. And if banking sector is going to get further benefit because of the liquidity measures of RBI, we are talking about a lot of upgrades in banking per se. Other than banking and IT, couple of insurance companies, HDFC AMC came out with numbers. The numbers were mixed, but I think there were more good points than bad points. There were more reasons for earning upgrades than downgrade. I think the confidence on earnings going forward, X of IT, should be much better going forward. That quickly covers the results. And yes, we maintain our view that Indian IT companies may see 2 years of earning degrowth. Hence, there is at least 15-20% more downside for them for the next 6 to 12 months. And we will with stay with our view that please avoid IT as of now. They are better places to be because the earnings are at a better level. Uh, we'll quickly touch upon my third point of the discussion for what is happening in gold. Let me first start by saying that I've always maintained that I don't know how to value gold because there is no underlying and I'm not an expert in gold. But such sharp movement in gold and being talked about so much made me read a lot, made me think a lot, and I think I found a logical answer to why what is happening in gold, and I thought I will share it with my audience. So, for this to understand, we need to look at the global macro. When you look at the global macro and trade, we find that over the last many decades, the the global trade was settled through dollar, and the strength of the economy or the ability of a government to settle global trade was driven by the foreign reserve, which was measured in USD. What has happened is that lot of countries, lot of economists, lot of central banks and stalwarts have realized that US is not out everything is right there much before that the Trump government came. And the weakness in the US economy will sooner or later start reflecting in the US dollar also. Parallelly, a lot of countries also started using alternate currencies to settle inter-country trades, while the proportion of that continues to be minuscule at this point of time. What it also meant is that the demand for the dollar outside the US was slowing down. Then comes Mr. Trump and his tariff policy and talks of de-recognizing the unreported dollar assets and everything creates an era of uncertainty around dollar. Now, if dollar loses its value over the next few decades, it will not happen overnight. Which currency will take over? That's something which I think nobody can answer. Hence, the alternate to dollar, which has been there for centuries now, is gold. That whatever happens, gold will remain a settler currency for all trades, and which is where people is and when I say people, I mean central banks and governments started adding gold and not focus on the dollar. Uh, I will say the dollar reserves, which is why if you look at it, India's dollar reserves is also not increasing heavily. We are not that much focused on increasing that, and that's true for a lot of other economies. Sooner or later, that will get reflected in the DXY, and which is why we maintained, and something which I've said in close quarters many times, and I will repeat that today, is over the next 10 years, I see USD, rather INR, appreciating a lot from the current levels to USD. This will happen because the strength in dollar in the US economy is going to go away. Now, does that mean that dollar loses its value and gold becomes much more expensive from here on? I'm not an expert to trade. But it will not happen overnight. US will take care of it. It's not that USD is losing its complete sign, and hence a balance will come into the picture. If US maintains its trades with the world, the tariff issues come down, then the sharp fall in the dollar will stop and it will become gradual in the nature, which may lead to volatility in gold. Today, gold is going up one way because there are more buyers and in rising prices or in the falling prices, nobody wants to take a contract. So I see a lot of trading also getting there. So I'm not taking a view on dollar here, guys. I'm only trying to explain why dollar is behaving like this, and the reason is for the perception related to USD and not anything else. I still believe the best asset class is Indian equities. I still believe Indian equities will give us a CAGR of 20% plus. if invested in the right stocks, and that's the place to be with least volatility. It was a pleasure speaking to you guys. I'll wait for a minute for questions. Else, we'll wish you good luck and we'll hope that next week we will see markets crossing over the critical zone and making new highs. Especially, I expect Bank Nifty to open on Monday, tomorrow, that is, with new highs after the kind of results ICICI Bank has shown, and HDFC also has delivered better number than the general trend they have been following. Wait for a minute, guys. Thank you for listening. Meanwhile, if there are any questions, you can type it in the chat, send me a WhatsApp, and I will answer that. With no questions, I'll take your leave, guys. See you around next week, hopefully with a bigger smile. Thank you, guys.